But I think what you're describing, and I've seen this in the data as well, is that in venture, it seems that past performance does predict future performance. Why do you think that is?
When venture was not that competitive in terms of amount of managers on the ground, then maybe you can harvest, let's say if you do land a great deal and then sort of you can harvest this luck into the future, promote, market it, and then you attract maybe better entrepreneurs into the future, etc. So maybe that you can create a rather clear flywheel effect. I think today venture is so fragmented, so competitive that only a handful of firms will be able to demonstrate that. But as a general rule, in venture, this will disappoint a lot of investors.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Justinas Milašauskas, I knew I'd butcher that, on the mic. He's an investment manager at Willgrow with 15 years across asset investing and prior roles spanning trading, institutional sales, and portfolio management. He's also an active angel investor and a member of LitBAN, which we'll talk about. Willgrow is a family office, diversified investment platform rooted in Lithuania. So we're excited to have him on the program today. Thanks for coming on.
Thanks, Brian. Super glad to be here.
So I usually kick off every recording with the same question. What's your origin story?
Yeah, well, it dates back 41 years ago when I was born in Vilnius, Lithuania. My parents were both bankers, and since day one, basically, I've been hearing all the terminology like margin, LIBOR, default, things like that. And probably subconsciously, I was basically driven to this field of finance, and math was my strongest subject at school. And I studied econometrics, which is pretty quantitative field. And I love numbers. I love finance. That was basically programmed consciously or subconsciously in my mind since day one. And I started as a trader in Amsterdam after graduating my master's there. And from that moment, it just kept growing from there. After trading derivatives, I joined a large asset manager called Aegon, which is multinational with the offices in US, Netherlands, and UK, managing portfolio there in credit. After that, I joined investment bank in Paris, moved to the sell side, then managed also fixed income portfolio and trading at a bank in Lithuania. And at some point, after changing, 3-4 institutional roles, I somehow was tempted to join a smaller, more nimble, let's say, hands-on activities that was in the form of family offices. So basically, my first experience in family office was at a smaller family office in Lithuania, where we were doing industrial projects, real estate projects, investing in a few funds as well. And at that time, I got familiarized with the venture capital, private equity that was outside of my liquid public markets experience that I had before. And this world just fascinated me because you basically could combine investment skill and add on top people skill, which is, needed to select teams, manage relationships, and get access to best opportunities out there. So during that role, I think around 2020, something around that time, I said it would be just great to invest my own capital in some of these funds. And obviously, I didn't have that much money to do that, to write minimum checks of 500K to 1 million. So I started pooling my friends and family's capital and accessing the small managers in mainly in Silicon Valley, created sort of proprietary fund of fund where I started investing my own capital, sourcing these funds and sharing best ideas with my friends and family who would also join on these opportunities. So that's how I started actually doing venture as a hobby, basically. And a few years down the line, since Lithuania is such a small world, basically people at Willgrow decided to start investing in venture as well. And basically we matched. We met a few times. We discussed the ideas. They liked what I've been doing, and I liked their vision and ambition in the space. And basically, we just decided to join forces. And I'm super glad. Now I'm working for 4+ years at Willgrow. Basically, professionalized my hobby from 5-6 years ago, and continue that journey at Willgrow.
Journey. Thinking back, what was there pivotal moments for you? Maybe a deal, a mentor, or a failure that reoriented your trajectory, especially at an institutional. I mean, starting in the public markets and then kind of moving to the private.
I think so. So as you mentioned, I'm an angel investor locally, part of Lithuanian Business Angel Network, and maybe there were one or two catalysts actually that impacted my path, and maybe I'm currently at. So first one was my first 2 angel checks were in old industry type of ideas. One was in a hotel, another was in the restaurant chain. So it was all to back friends, and it was exciting back in the day, 10 years ago, I guess. And they didn't go that well. And then I realized at some point, when I was still on these investments, now one is fully written off, another is, thankfully I received my money back without big profits. I realized, like, what am I doing? I should be just, investing in technology instead of these old style businesses. And that's how I started doing LitBAN, angel investing in technology companies. And my very first check returned nearly 4x in 2 years. So that was incredible success. Beginner's
That kind
luck.
of ruins you for all other investing, right? When you get a
Exactly.
When you get a 40x.
So then you extrapolate that. That's how it should always work. That's so
you're surprised
easy.
when the next one doesn't go that way.
No, I've written few off since then. So basically,
one of my first ones went 33x, and same. It was like 18 to 24 months. I was like, wow, I must be really good at this.
Totally.
Kind of ruins you for everything else.
So these two, I think, kind of shaped that. Technology is the right field, but it's not as easy as it can be sometimes. Given the amount of luck involved. But I think this is the most exciting asset class, and we see what is happening these days with the proliferation of AI, and so no turning back from it.
And there's a lot of doomers out there on the internet right now talking about, AI is going to take all our jobs, and and it must be like, being a farmer 1810, and you're looking at all these, factories and tractors and equipment coming to the farm, maybe in the 1800s, not 1810, but probably in the 1800s at some point. You're like, wow, we're not going to have anything to do. All these machines are going to do all our jobs. What could we possibly do if all these machines are doing all our jobs? And I think we're kind of at that moment now in the 2020s as we record here in 2025. It's like, oh man, AI is going to do all this cognitive work, and what are we going to do? And we'll do podcasts and do stuff like that. So tell us more about Willgrow. What's the kind of the charter there? What's your mission? What was the kind of the origin story there?
It all started 30+ years ago with one truck, and the rest is history. So basically, our principal in 1990s, early 1990s, just bought a truck with spent all his money, and the company basically bootstrapped for until today. The thousands and thousands of trucks on the road now in Europe, largest asset heavy transport company. And after that, they invested a lot in real estate, built another company, which is the largest regional warehouse business called Sirin. So incredible success on the business side. And at some point, you have to put a strategy, how to reinvest, how to sort of think about the future and capital. And Willgrow was started nearly 10 years ago, gradually, investing in bonds, in real estate projects locally, and, started with one person's CIO, and then gradually every few years, a new investment manager would join. Now we're 5 on a team. And we actually, our evolution was from a local investor in, opportunistic ideas, single asset vehicles, mainly in real estate and in some private credit, direct lending stuff for local developers or companies to global player in private markets. We invest now, we have nearly 100 manager relationships around the globe across buyouts, venture, private credit, real assets. Venture has been the newest asset class that we added. That's when I joined 4 years ago, give or take. And it's all global approach. US probably takes up 2/3 of our investments. The rest is Israel and Europe. Obviously, Europe dominates that part. And the vision is to be very good in fund selection. That's the only core skill that we practice and fine tune every day. We try to be better in that, and we think this will generate strong alpha over the cycle. Markets go up, markets go down, markets close, markets open, but manager selection alpha persists. So that's what we focus on, and that's our objective.
That's amazing. So you've grown to 5 investment managers, and I would imagine each one of you has a different area that you practice. So what are those 5 areas?
Exactly. So it's buyouts, credit, venture, real assets, public markets as well.
Interesting. And so you guys have taken the tact of, especially on the venture and startup side, of investing in funds rather than directs. Tell us about kind of what drove that decision.
Yeah, so I think it's a function of few elements. First, we're not that huge in terms of assets. We don't have pressure to invest and direct deals, or let's call it co-investments, are probably the fastest way to employ dollars or euros from day one. We don't have that problem or issue. We said best idea wins. If we don't find, we just don't invest. So, and the other item is we've done few co-investments. We've noticed some of them were pretty successful. Some of them are still TBD. But what we noticed that it takes a lot of time, and then you have to drop everything, start spend a week or two on the deal, and then come back with sort of to your day-to-day, so to say, fund selection, travels, for instance, diligence, friends calls, things that we do every day, not that productive from our side. So we said, okay, there's no need, no FOMO, no need to rush. If we decide later down the road to do that, which I think is a likely path, we can talk about that in a moment. At first we build a bulletproof fund portfolio, and I think it's a natural evolution of the family office. We call ourselves emerging LP. We were pretty new. We're still learning. It's a natural evolution to build a bulletproof fund portfolio and then take it from there with an open mindset and build maybe a small team of 1 or 2 people dedicated on that activity.
Really fascinating. So I almost have the exact same journey that I followed personally on the real estate side. So I grew up, my dad was a fixer flipper, entrepreneur kind of guy. So when I was in my 20s, when I was in and out of Wall Street and stuff like that. And so I was doing a lot of real estate deals, directs. I'd buy a house, fix it up, sell it, rent it, those kind of deals. And I did probably 50 of those in my 20s. And I was making good money, but I wasn't enjoying the work, like what you said, like you drop everything, you got to work on the deal. And then, so I sold my real estate holdings, and then I started being an LP in deals, right? And then even that started to just be a lot of work, all the individual deals, these dozens of updates, like, what's going on with each of these. And now I've kind of graduated on my real estate portfolio to just doing funds. I just hire a GP. I know they're good at what they do, and I'm going to pay them the 2 and 20, or in real estate, sometimes it's like, it escalates even to 30, but I'm going to pay them the money that they deserve to go manage this money properly, right? In this asset class. So that's really interesting that you guys have kind of come to the same conclusion and picking funds. And it is a lot of work, to look through deals and do due diligence and keep up on a portfolio. And, a lot of my day now with 250 portfolio companies goes to managing the portfolio. And I try to build automation and systems, and I have an assistant and everything, but a lot of AI to kind of keep tabs and a lot of automation, but it is a lot of work to keep track of all these startups. How do you guys balance allocations between these asset classes, or how do you think about that?
Yeah, good question indeed. That's where we spent the whole day last Monday on this topic. Basically, that's what we call strategic asset allocation, and how do you define weights and trajectories of the the whole investment portfolio. So I think it boils down to a few things. First, we decided to be diversified. We decided to be in the private markets. We are fine with the liquidity. We said, manager selection is the source of alpha through the cycle. And these are sort of remain stable pillars of our activity. What can change is always, you can fine tune weights and proportions and some tactical things surrounding these pillars. So how do we define weights and sort of targets? First, it's very important that asset class portfolio has a meaningful weight, but not too large. So our rule of thumb is somewhere between 10 and 30% is probably the range where the asset class makes sense to start doing or to keep in the portfolio. Then we look at sort of properties of each asset class, volatility or risk, and then returns, the dispersion, dispersion within quartiles, dispersion between quartiles, things like that. And then you sort of define internally what is the most preferred based on, some of these metrics, what is least preferred and has lowest weight. And that's how we came up sort of stack ranked buyouts at the top with a 30 to 35%, venture as a second 20 to 25% long-term target, credit around 10%, real assets around 10%, and the rest is in liquid, bonds and equities. These would be the approach, and then every year we review our assumptions for each asset class, because it was funny. So this year we looked at assumptions for all asset classes when we started these asset classes. So venture 4 years ago, buyouts 5 years ago, credit 6 years ago. And, for venture was 5-year rolling IRRs at 9%, things like that. So buyouts also looked incredible hits. And then you see assumptions and sort of change over time. And then you can sort of readjust your views and preferences. But we haven't done any big swings in our allocation because it has a lot of inertia, obviously, in privates. But secondly, these sort of relative rankings, from our perspective, they remain pretty much the same for the past few years.
So fascinating. It's incredible. On your venture portfolio so far, you're clocking a 29% IRR, which is really great. That's, probably top 5 or 10%.
So it's not us. So just to clarify, so we started venture in 21. And at that point in time, when we were starting venture was showing incredible performance.
Right,
so at that point,
was an incredible year.
Yeah.
I mean,
so in end of second quarter, 2021, venture had rolling 5-year IRRs of 29%. So, and now when we look at 5-year rolling IRRs from today's standpoint, it's at 14%, 15%, right, something like that. So assumptions and sort of situation and market dynamics, they change over time. So we need to always evaluate that. Our portfolio in venture is still young. Since we started 4 years ago, we're super glad that it's out of the J curve. It starts already showing good signs of, performance.
Yeah, that's fascinating. So let's talk a little bit. I had one more question here on asset allocation, which is how does liquidity and maturity timelines factor into your asset allocation decisions? Meaning, a lot of family offices I talk to will say, hey, yeah, great, you got great performance there, whatever, but it's going to take 10 to 15 years for an early stage venture fund to really fully mature. And we're too impatient. We need a 5-year timeline.
Yeah, absolutely. Great questions. Again, back 4 years ago, the 2021, the liquidity profile yield, say cash yield distribution yield was around 30% in ventures. So meaning, over the course of 12 months, you get 30% back of your NAV or get your money back after 3.5 years, basically, after investing. Today, the yield is around 9%, 8-9%. Means basically 10 years to get your money back. Again, very different regimes, very different environments. So from 21 to today, we actually done a lot of things as a function of the changing environment. So we saw that squeeze happening, and since T2, we started to be investing in secondary funds. Secondary funds, they're much shorter duration because our core thesis on early stage. pre-seed and seed managers, and we started seeing the J curves getting longer, deployment pacing slowing down. So we realized we need to do something because we still like the asset class, but then liquidity, can become a little bit of an issue. So we started doing secondaries to balance it out, to smooth the J curve, to get liquidity going. Same exactly happened in our buyout portfolio as well. So we just took measures at that point of time best we could.
So you're in Europe, and you guys got to be probably watching the dollar get deflated a little bit over the last year. I think we're down 10 or 15% over against other currencies. How are you guys thinking about that as LPs?
Yeah, so that's indeed a topic internally, and I think in a family office's setup, it's all about let's say the principal and his, let's say, view of earnings and potential expenditures in terms of currency, like, okay, is it in euros, is it in dollars, how it's gonna look years into the future, etc. So actually we are quite flexible in that respect. Our target currency setup is 50-50 US versus Europe at the moment and into the near term future, and that's pretty much exactly where we are. As I mentioned, 50 to 60% is our US investments, and this fluctuation is impacting our management reporting in euros and maybe end of year balance sheet, let's say, values in financial statements. But all the financial or investing performance that we track, performance of managers, it's always in local currency. So if manager fundamentally is flat, did not add value, but the currency moved 20% in his or her favor, then if we sort of don't take into account, we might say, oh, it's a great performance, but then it actually means nothing because it's just the currency moved. So we always exclude the currency, and that the US managers look in dollar IRRs and TVPIs, European manager in euros.
Yeah, fascinating. Let's talk about deal flow. How do you guys find all these GPs to evaluate?
So a few years back when we started venture, we realized we're far away from, financial center like London, New York, SF, and we need some help, at least avoid adverse selection issue, which is super prevalent in venture. I think in buyouts, it's still the case, but venture is incredible in that. And especially, if we talk about directs and co-investments, that gets even worse. But so we said, okay, how can we solve that? So we took a few steps. First, we are 4 times at least in US ourselves for a week or two, attending key events, meeting other family offices, LPs, etc. So that's one. Second was to build a strong established LP network. So we realized we're emerging LP. We need to find like-minded people who are more established, that they have done, venture, private equity for 10, 20 years. And that's what we've done successfully and then continue to do. It's an ongoing process. And we realized that we need to partner up with fund of funds and bring on board advisors to the family office on a portfolio level, on an asset class level. So that's what we've done on the venture side. So fund of funds help us a lot. It's incredible sparring partner. We get a lot of insights, from people on the ground in the Bay Area, in New York, in London, or in Germany, wherever they are. So we backed 4 fund of funds in venture, a few in buyouts. So that works really great.
So you get a bunch of pitch decks, like probably I do for startups. So you're getting all these GPs pitching you all their funds. What are some filters, especially on the venture side, or red flags you apply when you're kind of doing that first screen?
Yeah. So initial screening, it's all about GP strategy fit. So we look at biographies or people profiles and try to understand why are they doing the strategy. Does that fit their profile to the core? And if we have any doubts on that's immediate pass.
So it's GP, first and foremost, GP market fit. It's like,
exactly,
this GP has a good GP market fit. There's a why.
Exactly. And that could be, I don't know, operating experience in the field, in that, area. It could be previous investment track record in the space, various items in the background of a GP or a team that indicate that this is the right fit between the team and the strategy that they are going to be executing. So that's initial, let's say, checklist. And then if we get comfortable with that, we look what have been the signs of success in the past while being active in that field. Again, it could be, I don't know, unicorn exit in
So you're looking at track record,
enterprise infrastructure, maybe a topic, and now the person is sort of creating enterprise infrastructure fund. So it's not necessarily we need to see, I don't know, 10x on realized in previous fund or funds. It could be successful angel track record investing. So factors like that. So we look at success via various angles.
Yeah. So it sounds like you'll look at first time GPs as well. Like, hey, I'm just starting my first fund here.
True, and this is very hard actually. That's why we want to look at the whole space. For us, we don't have a predetermined bucket or weight for established, emerging, things like that. So we just look at the manager, and being emerging is just one of the features. It's like, I don't know, the team of 3, team of 1, solo, things like that. These are just features. So we look for the fit, we look for success, and then we let's say put it into our pipeline, dig deeper, and also discuss these managers with our fund of fund partners. So, did they invest? Have they looked at them? Why didn't they look? Because the third layer is probably what we could call, let's say, soft referencing. It's like, are these people credible in the area? Do they have, are they
the LPs
operating
on the cap table and
works? Are they sourcing from relevant networks? Have they done anything in the past to piss founders or anything on the positive or negative side? So we don't have these insights from, let's say, being far away. So that's why we just talk to our LP network, fund of funds being part of that, and a lot of interesting insights, and then we either continue or discontinue from that point.
That's fascinating. So when you're thinking about your portfolio, do you prefer to concentrate in just a few funds, or do you prefer a little bit more diversification? And how do you think about kind of building that portfolio in venture in particular?
Yeah, it's funny. So when we started, we thought we know it all, and then we started in a concentrated way. The more we do it, the further into the forest we are, the more the trees there are. So it's getting a bit. It seems so challenging, but that's sort of a little bit of humor. But I think it depends. So at this moment, especially since 2 years ago, since ChatGPT moment, we realized, hey, this market is changing for real. So the modes in startups, they will be blurred. There will be, few large infrastructure winners, but then, on application side, who knows how all the things will play out. For your for the best idea of the manager that he or she backed a few weeks ago, there are 20 competitors after 1 month, and then after 3 months that there's even better idea in the same field. So the opportunity set, the competitive nature, the modes, they just changed dramatically. So we realized that it's also becomes so much harder for us as LPs to pick winning fund managers with a very high conviction. So we, since 23, started to diversify a bit more. So we write slightly smaller checks, but a few more checks per year to just, diversify, capture maybe, some ideas that we wouldn't be able to capture in a more concentrated way, and give us a little bit more, security or visibility into some managers and the ways they invest, and we'll see, and maybe when the market sort of settles down or changes a few years later, etc., and then we have these relationships, maybe again we can concentrate a bit more. So I think it's very dynamic. So what we said to ourselves is we will always be investing every year same amounts or even more, and we'll continue doing that for many years. But that this will not change. But what we can change is that how we sort of where we invest. Maybe we do more secondaries, maybe we diversify more, maybe we concentrate more, maybe we go more with a sort of a micro funds or go with multi-stage funds. So this remains to, more flexible to navigate depending how the market behaves.
It's a multidimensional problem, and it's fascinating to think about, right? Because you have 5 different practices at a small family office, or smallish, smaller than some.
Yeah.
And you think about all the asset classes in the world that you could be investing in. And there's 5 people, doing 5 different things. And then you just dive into just venture, and you start thinking about just venture and how complex, you have different stages, multi-stage, you have different geos, you definitely have different sectors, you have generalist funds, you have niche funds. How do you think about all of those options? There's just such a menu in venture capital.
Yeah, it is, especially if you open PitchBook and just directory of all funds and thousands and thousands of managers, then your head starts spinning. But I think the part is that our job is basically to say no 99.9% of the time. And
I say that a lot too. I say that exact phrase. My job is basically, you're paying me to go say no, 999 times out of 1,000, basically. I only invest in probably 1 out of 1,000 startups I see, maybe 1 out of 500. So that's literally my job.
This is just a job and nothing personal, so many great ideas out there, but we just try to be very structured, very disciplined. And then even after saying to these, to all of these no's, when I look at the pipeline, it's still like, 20, 30 managers where we need to select, to 10. So that's why we need extra layer of help, as I mentioned before. So yeah, I think.
What's interesting about the fund of funds, I've talked to lots of them over the years. They'll typically look at me because I'm a pretty diversified, 150, 100 per fund investor. And they'll go, well, we're kind of looking for niches. Like, do you hear the same thing from your fund of funds advisors? No, don't invest in generalist funds, but here, pick, 5 niches every year.
Coming back to the generalist, specialist, and all the opportunities out there. So I think we try to be flexible. Again, best idea wins at Willgrow. So we look at everything. We say no to many ideas, which is normal in this opportunity set. This, big set of opportunities across all asset classes. For specialists, because you can make a case for both. There are, incredible investors, both, in specialist domain and generalist domain. So a lot of, research and data have been made, produced, published all over internet. Okay.
I would imagine you can find stats on both sides. Oh,
exactly. Totally.
No generalists outperform, no specialists outperform, no early stage outperforms, no late stage outperforms,
Totally. Small funds, big funds, things like that.
To tell your story in any way you want to shape it.
Yeah. But the way we think is there is a handful of really large sectors, enterprise, fintech, cybersecurity, biotech, and few more, where we think it makes sense to go with a specialist, especially at the earliest stages, where they can add a lot of value. When you're at the sort of pre-IPO or late growth, then any crossover, any large fund can just do their calculus and spreadsheets and then just write a check. So we don't think we think specialist makes most sense at the earliest stages of company lives. And then going to generalists, I think it's a higher bar for generalists, because what generalists need to show, they need to show that, okay, over cycle, people are able to identify not only best companies, but also best sectors, because, maybe a few years ago, people were investing in crypto at some point, then in tech bio, and then at some point, in AI, I don't know, cybersecurity.
Fintech was really hot,
and then consumer before. So as a generalist, universe is so broad, but then you need to show some evidence of being able to narrow it down based on some algorithms or methods that you have, in the house, and to show this track record of being able to, what I call, pivot, from vintage to vintage to emerging sectors, not only emerging sectors, but sectors to be emerging, 5 years later, and capitalize on that. So it's even harder. When you're a specialist, you're doing just sort of, I don't know, life sciences, early stage biotech opportunities. You're very good at that, and you just keep producing these returns. But being generalist, it's super hard. We found few teams like that. We keep looking, and I hope it works well.
That's great. So you've picked your funds, and now you're in the monitoring and evaluating phase. Like, how are you benchmarking? What's your valuation policies that you tell your GPs to follow? Like, how are you monitoring these portfolios?
Yeah, we're low maintenance LP. We're not inferring for GPs how to do their job or evaluate stuff. We need to understand that, and then we'll evaluate. Of course, for re-ups and in between, we can have a chat on that. But the way we do that, the way we benchmark, so we use Burgess database, and then of course we have we look at all the funds in given vintage. We benchmark them to understand how the funds are tracking in terms of net IRR and net VPI, and obviously DPI, but it's still too early on the DPI side for us since we started for years. So that's one. Also, maybe it's not that common, but family office, we sort of have a evergreen structure, and it's sometimes when people ask, okay, so how many funds you invest? I'm like, yeah, it's not like closed-end fund of fund vehicle where you say, okay, in this fund of fund, I just do 15 or 20 deals. That's it. So we are evergreen. So it's always, kind of evolving. But internally, we said, okay, let's look at it, at the portfolio from a fund of fund perspective. So we have a 3-year, let's say, vintage approach, and now we're on vintage number 2. And then we take these vintages, and then we put all the funds in these vintages, and then we benchmark with fund of funds as well, not only in our portfolio but also on the Burgess database. So various angles, but it helps us understand how we're doing things, where we're going, and then we can answer question better. How many funds are you backing? So then we say, okay, per vintage we back 50, 20 managers.
So, and how have you course corrected now that you've been doing it for years? What have you learned? What did you wish you knew like 4 or 5 years ago that you're now practicing?
I think first is ticket sizing. Second is selecting 1 out of 1 and to double click on those. So it used to be, you meet or get intro with the manager. It looks great, ticks all the boxes, and then you pull the trigger. So it's not the case anymore. So we kind of mapping things out, talk to all the peers in the space, competitors, and then try to, pick the best from that, let's say, sector or even a region. So we would 1 or 2 sort of geographically focused managers. So that's one, and the other is sort of ticket sizing. As I mentioned that at the beginning, we were more concentrated. So that's one factor. I think we were also certain ideas about the future growth of the assets, the future liquidity. When you look at all these distribution yields at 30%, then you say, okay, in 4 years, I get 1 DPI and things like that. Then you project all the sort of portfolio, and then you say, okay, I need to commit this amount because then the assets grow so fast. So it has to be meaningful. So we're not doing these sort of projections out of thin air. We sort of more looking realistically, and that's why the ticket sizing has scaled down.
Let's talk a little bit about emerging managers for a second, right? Because you're looking at first-time fund managers, which is super risky. How do you kind of filter through that and balance between that and, say, like an established manager? And I think established managers technically are usually on fund 4, right? So call it the first 3 funds as emerging. But let's really talk about the first 1 or 2 funds. What are some red flags that you're just like, oh, that's an automatic no?
First time.
What's that?
First time team.
First time team. Okay, tell us more.
So we've been mapping one country in Europe. It's a big one. We have a strong conviction that it makes sense to have a manager based in that country, sourcing locally pre-seed ideas, because these ideas can hardly be captured well by the manager based in another country. So we did all this mapping, and then 2 finalists came out in the in our rankings, and one was fund 3 with the team that has been established and worked together, and then fund 1, which referenced super well, was very hot, nearly oversubscribed manager, but it was a first time team. So we went.
Meaning they didn't have history together, like they just kind of came together to do the
Well,
fund.
they had history together, kind of, but they were not part of same fund or team or business or work.
They knew each other, but they hadn't worked
They
together.
knew exactly.
Yeah.
They knew each other, hadn't worked together. And 6 months later, we hear that the fund hasn't closed yet. We're still in the process of closing, but the team just collapsed. So basically, they went separate ways. So it just illustrated, and we were super lucky and glad, but made the right choice at that time as well. So for us, it's absolute number one item for let's say first time funds.
Yeah, it's something I look for too when I'm evaluating a startup. I mean, that's a pretty red flag. Yellow. Yeah, that would be kind of a yellowish flag for me. I mean, I think it's like a must have actually. It's you have to. How are you going to go do a startup, which is more intense than a marriage, will last longer than most marriages if you haven't like worked with that person before. And I'd say the same thing about a fund. A fund's even longer than a startup. A fund could be 10, 15 years per fund. So yeah, I could definitely see. I wanted to circle back on evaluating like markups in particular. One thing that I tend to get in disagreements about is cap adjusted markups. So we do pre-seed, so we're investing at 5 and 10 caps in the pre-seed, right? And then they get a seed and it's still on safe, so it's cap adjusted, and say it's a 20 or 30 cap. So I'm like, well, I'm going to mark that up. I'm going to say that's a 4x markup or 3x markup, whatever it is. And then some LPs will push back. They're like, well, that's not a real markup. That's just a safe markup. And I'm like, no, that's another round of financing at a higher cap. And by the way, the priced round will happen eventually, and it'll probably be even a higher cap. So I'm going to take that intermediate mark. Yeah. How do you feel about that as an LP?
Yeah, so officially you need to report on priced rounds. So that's where all the metrics, quarterly metrics. That's how your metrics are produced. But we always want to know the other markups as well based on caps. So I think that's totally fine. It gives a direction of the fund. Of course, one can double click on some of these cases, how has been the performance of companies since these safes been written, etc. So, and then you can create your own, let's say, version of the.
That's what I've basically done. I've done 2 performance metrics. When LPs care is I'll do, okay, this includes all the cap adjusted stuff, and this is only priced. So I literally have a new column in my Airtable where I keep track of my portfolio, and if it's marked, like the default is cap adjusted, and I only flip it to priced if there's a price round. But in pre-seed, these price rounds can take 4 or 5 years, from that pre-seed round, because you'll do another seed on safes. Sometimes you'll do priced. I'd say 3/4 of the time the seed is also on safes. And then when you finally get to the A, I mean, that could be 4 or 5 years into the startup's journey.
Totally.
I wanted to circle back on diligence and double click on diligence for a sec, in particular data rooms. As you're constructing a data room, what do you look for, especially with, in venture? What do you like to see? What do you think is superfluous? What are some kind of red flags that you've seen in data rooms? What's the best data room you've ever seen? What was in it?
I think one can always remember the worst data room. I mean, there is no best data room, I think, in this world. But imagine my shock after spending, so many years in the public markets, all the disclosures, notes, all the addendums, etc. Seeing the data room of the venture fund, that's kind of shocking. So there is no good data room. I think every data room can be better, and it would be fantastic if all the data rooms would be standardized, because everybody's looking at the same thing all day long.
Right.
Just representation.
I feel the same way about startups data rooms and our pitch decks. It's like, can't you just get with the program here? Here's exactly what you should have in your data room. I give them a checklist. But go check off that all these things are in the data room before I look at it. If they're not, like, or say I'm not going to deliver it or something, but I like that, every data room should be standardized. So what are, the top, 5 or 10 things that every data room should have that you look for?
Yeah. So obviously, schedule of investment in a detailed fashion, initials, follow-ons, co-investors, ownerships after each check, things like that, the dates. If there is attribution, then who led this from the fund side. So some words on the company, maybe some company metrics, but it can be in a separate file as well.
What do you see as like the world-class GP CRM out there? Because there's a few out there that are. Do you like any particular platforms? When you see, hey, that GP's on that platform, I really like that platform. I know it's going to be really well organized, or is it all just all over the place?
Yeah. So And going back, it's basically, all these investments, some memos maybe on some deals that we ask to understand
So
the
I have
logic.
150. This is a question for me. I'm getting to prep my next fundraise with you. I have 150 deals per fund. You want to see all 150 deal memos, or you just want to see the ones that are marked up? Or
No. So it depends. Sometimes we want to see the memo of the deal that went to zero. Sometimes we want to see a memo of, I don't know, you're just like average, regular deal, or maybe the best deal. So I
like
think
a kind of selection of the misses, the hits, and
yeah,
some
just
of
the
the.
thinking, like what played out, what didn't, and
Mm.
yeah. So for us, it's not a necessity to have, I don't know, 10-pager on each company produced by a manager, but at least some structured format, how you look at things, maybe, 2-pager with something. But then we want to talk about that deal, and you sense, how well articulate, how well sort of, how deep the manager went on certain thesis and rationale, and this discussion can be super and much more productive than me reading a 10-pager. So I think that's how we look at it. What else? I mean, standard stuff, some legal docs, then deck, bios, reference list. Although we do probably at least half of references of the off-sheet
Back channel.
references. Yeah, exactly. So, but it's still helpful to sort of, because we know these references will be sort of supportive. That's why people place it there. But it gives a certain signal of the networks, which networks, surround the manager, and sort of which people, GPs, other GPs, or LPs or founders, big all a while, and who's on the list. So that gives a little bit of understanding in that space. We can always, double click in certain areas for more clarity. Yeah, I think basic things.
What about fund admins? I've been hearing from some of my GP friends that there are fund admins that LPs don't like. When they see it, they're like, I don't like that fund. Like there's Carta, there's AngelList, there's a bunch of others. Are there any fund admins that you particularly like or dislike?
No, we don't put too much weight on that in venture, especially. In buyout, it's a different story.
Oh, interesting. What's good in buyouts?
Well, it has to be well known. It has to be super established. So that's the key. If we see first time, then it's a yellow flag. So.
Yeah. So kind of the fund admin's kind of an afterthought here. It sounds like. Let's talk about the future. What's on your radar over the next 3 to 5 years as an LP?
I think more of the same. Just keep fine tuning the fund selection skill. Meet the best, not necessarily on their fund one, but fund two works well as well, because sometimes these fundraisers are super fast. He spins out, just raising,
I've seen funds close in a week, because
exactly in a week or two.
Yeah.
Existing LPs, just move, tag along, and it's like, we don't chase. We're fine. We just, find good opportunity to meet them in between the fundraising cycles, build a relationship, and back in fund two. We've done a number of times like that. So there's no rush from our side. But the key objective is for us to meet the best, emerging managers at least on fund two. Otherwise, we will continue, do investing in all these asset classes, in venture buyouts, credit. We will be, in US 4 times a year, Europe, every other week, Israel. So these are core geographies. We might spend a bit of more time in some other geographies, India, LATAM, maybe China at some point. So it's sort of a top down, but also bottoms up. The best idea wins.
Well, let's wrap up with some quick questions, some rapid fire. What's a book or an article you've recently recommended to your team or to some of your LP peers?
Well, it's a good question. I read, and I mean, everybody on our team read the book Why Nations Fail. I think this is the most read book at Willgrow. It's fascinating, fascinating storytelling, how things played out in history, and just to put everything into perspective. That helps a lot while maybe evaluating some new geographies. Are these inclusive or inclusive markets, or full of problems, things like that. So That's one. I've read a book, by Alex Ferguson, how he, his story, how to lead the teams, top-notch teams, and select especially talents globally. And he never overpaid, but just found best players ever, like Ronaldo, at a young age. So that's for us like manager selection from Fund One or Fund Two. So yeah, books like that, a bit about work, a bit about real life.
Which startup or technology outside of your portfolio are you most excited about? So when you're evaluating a new GP, what's one metric that rules them all?
GP strategy fit, and it's not a metric, unfortunately.
Yeah, it's kind of more subjective. How do you personally stay up on all the trends in venture? There's just so much. I mean, I'm in a particular niche, a generalist in a niche, but a focused generalist. But you have a much broader aperture. How are you staying up on everything?
I have to read a lot. That's one. Talk to people a lot. But I'm in a lucky position that our best managers, our best generalists tell us what are the next big trends.
Right. Yeah. That's one of my favorite things is my newsletter, writing like, okay, here's what we've been seeing over the last 6 months. Here are the trends. Here's how things are shifting. It's really fun. And you can basically tell just by, all the pitches you're getting, right? You're seeing the trend. I'm on the ground day after day, seeing what's happening and who's getting traction and who's failing and stuff like that. What's an assumption about investing, particularly in venture as an LP that, or venture capital generally, that you think will be proven wrong in the next decade?
Persistence of returns. I think we see a lot of FOMO or things that sometimes you are thinking why certain things are happening, especially with the certain managers that had maybe one great company in their fund one, and then it seems they don't need to think about fundraising for the next like 4 vintages. I think that this is tricky. This is very tricky in venture when things are so dynamic. Of course, the research shows that venture is probably the most persistent asset class in terms of performance, but I think it's prone to a lot of disappointment.
Yeah,
sure.
meaning like in public markets, past performance is not necessarily indicative of future performance, especially for public market investors. But I think what you're describing, and I've seen this in the data as well, is that in venture, it seems that past performance does predict future performance. Why do you think that is?
Well, when venture was not that competitive in terms of amount of managers on the ground, then maybe you can harvest. Let's say if you do land a great deal, and then sort of you can harvest this luck, into the future, promote, market it, and then you attract maybe better entrepreneurs into the future, etc. So maybe that you can create a rather clear flywheel effect. I think today venture is so fragmented, so competitive that only a handful of firms will be able to demonstrate that. As a general rule, in venture, this will disappoint a lot of investors.
Yeah, I think there's like this natural life cycle for GPs, right? Where if you are able to get, inertia and momentum to get off the ground, get your flywheel spinning, you start getting access to deals, you start adding value to those startups, and then you get network access because of your past network access, and it kind of spins on its own. And I'm kind of seeing that at Team Ignite now after 5 years. It's kind of spinning, and we have momentum, and the flywheel effect is happening. But I think there's also this natural life cycle, right? Where if you're in venture too long, you kind of become disconnected. And there's this like natural, like almost like forced retirement age. And you'll see this with, old GPs, they sort of, hand off the investing reins to the new generation. And once they hit about 60, 65, it seems like, because you just sort of like, you're kind of out of touch and you can't really understand what the 22-year-olds are doing. I hope I never get there, but yeah.
And I think the paranoid will survive. Like if you're so paranoid that
the paranoid will survive.
Anyway, so I think the ones that are really paranoid that they might not sustain, their success, how they can reinvent and, constantly adapt, those will be the most successful, people or managers over time. If this flywheel is taken for granted, and then it's sort of, I think the market will just show something else.
Well, this has been an awesome conversation. Thanks so much for coming on. I learned a lot.
Thanks, Brian. I appreciate that.